Good afternoon, everyone. Good morning to those on the West Coast. We're going to give it one more minute before starting the meeting. Thank you for joining us today. We will get at it in 60 seconds. Good afternoon, everybody. Thank you for joining us. My name is Robert Beatty, and I will be your presenter today discussing max-funded life insurance. So an overview, today we're going to discuss one, current fiscal situation, current taxation, where our income tax is going, our taxes going up, and then we're going to discuss non-modified endowment life insurance, non-reportable income, additional features of overfunded cash value life insurance, how you fund it, how you structure it, and take distributions, who it's appropriate for, and then just a recap of all the benefits that goes into maximum funded life insurance. So I always like to address the current fiscal situation in the United States, where we all pay taxes. Currently, the aggregate debt of the United States is approaching 124% of GDP at $37.5 trillion. We have the third highest debt to GDP ratio in the G20. The G20 is the top 20 industrialized nations in the world from measured by gross domestic product. And only Japan and Italy have a worse debt to GDP ratio. The deficit for 2025 is 6.4% of GDP at $1.7 trillion, and it's estimated to be $1.8 trillion in 2026. These deficits and debt ratios are higher than they were during World War II. It's at no time, peacetime in our country, have we been carrying such large deficits and such a large debt burden in relative terms and certainly in absolute terms. The current tax bill that was cut, the big beautiful bill, is going to add between $3 and $4 trillion to debt over the next decade. And again, it's just math. It's not a political opinion. It's not anything. If given the current circumstances and some reasonable assumptions about growth, GDP, tax revenues, it's going to go up another $3 or $4 trillion. I just want to put this in perspective. In the financial crisis in 2008, and the whole Tea Party movement and the whole movement towards people getting tired of deficits and debt. The entire bailout in the 2008 financial crisis was $750 billion. $750 billion. And we are currently running deficits of 1.8 and 1.7 trillion dollars. And no one's really addressing it. No one's really speaking about it presently. It's estimated that over the next 75 years, the unfunded liability for Social Security exceeds $28 trillion, and for Medicare and Medicaid, it's $53.1 trillion. Again, it's demographics. It's the number of people going to be over the age of 65, how we're going to pay for it. Current Social Security situation, a little side commentary here, is that if they do nothing, Social Security benefits will be reduced by 24% sometime in either 2032, 33, or 34. mean, Social Security is not going to go bankrupt, but the only way to solve the Social Security problem, the shortfall, is that they will cut across the board everybody's benefit by 24%. And again, it's not on anybody's agenda. I've not read or seen anything about people proposing solutions in Congress, in the administration, in any of the parties' political platforms. They're just all kicking the can. What is our current taxation? Federal income tax rate is 35%. Once a single person's income exceeds $250,000 and a married couple exceeds $500,000. Capital gains is 15% for income between $48,000 and $533,000, and it's 20% above that. For joint, it's 15% from 96,000 to 620% above that. There's a Medicaid tax. If your investment income exceeds 200,000 as an individual, 250,000 as a couple, there's an additional 3.8% Medicare tax. There are no personal exemptions in 2025. Medicare, there's an additional tax on income in excess of 200,000 for individuals and 250,000 of 0.9%. Current Roth IRA income limits is $150,000 for a single person and $236,000 for a married couple filing jointly, which means that if you make above those amounts, you cannot fund a Roth IRA. Where are taxes going? So I have my cute line is, I dropped my teacup in a wishing well and I haven't seen the future since. I've stopped trying to predict what taxes are going to be, where things are going to go. In 2009, I'd have never predicted that estate taxes would go away completely in 2010. I would have never thought we'd be today, January 1, 2026, we're going to have $15 million per person lifetime estate tax exemption, $30 million for a couple. But given the fiscal situation that I just laid out, our effective tax rates are at the lowest points in our country's history. Well, since income taxes have been in place, which is, started in the early 20th century, they're at the lowest levels that they've been in some time. Again, we just passed an extension on the 2017 tax cuts. If you're looking at astronomical debt and deficits, low tax brackets relative to historical norms for income taxes in our country. If you were going to hedge about taxation in the future, which way would you hedge? Or would you be out saying, I'm going to make all my planning decisions based on even lower taxes 5 years from now, 10 years from now, 15 years from now as I go into retirement? If you think that taxes might go up, life insurance is a powerful tool to leverage to get tax favored treatment and provide private beneficial transactions to achieve your desired outcomes. And then I always go, when should I do it? My answer is yesterday was better than today, and today is better than tomorrow. The sooner anyone starts on this type of a planning strategy that we're talking about today, the better it's going to be, right? The longer time we have for the deferrals and to put money away and shelter them from taxation, the better. So if you think taxes might go up, if you think they might be higher tomorrow versus today, would you fund a traditional IRA or a Roth IRA? Just rationally thinking, which one would you do? If you could get an unlimited amount of funds into a Roth IRA, how much would you do? Well, unicorns don't exist. As I stated earlier, there are limitations to what you can put into Roth IRAs. Even if you're doing a Roth 401k, there's limitations to what you can put in. And if you make over certain income amounts, you can't even do that. So unicorns don't exist, or do they? Overfunded, non-modified endowment cash value life insurance. It's funded with after-tax dollars. Cash values grow tax deferred, and distributions can be taken out income tax free, and they are non-reportable income. Overfunded cash value life insurance has a whole lot of other features that we will talk about other than Roth-like accumulation and distributions. But as financial advisors, I've seen people call overfunded cash value life insurance a super Roth IRA. We can't say that to consumers. Um, it walks like a duck, it talks like a duck. We got to call it life insurance because it is life insurance. So it has very similar taxation characteristics to Roth IRAs. So non-modified endowment life insurance, a tax-optimized accumulation and distribution solution. Tax-deferred growth, tax-free income, non-reportable income. Roth-like treatment. No IRS distribution guidelines to follow. There's no 59 and a half age restrictions. There's no 10% penalty for early withdrawals. There's no required minimum distributions once you achieve some age. You have complete control over the timing of the accumulation and the timing of the distributions in the product. It's non-reportable income. IRC section 7702, 74-500, IRS section 72E. Chapter and verse here, guys. I mean, if you want a copy of the presentation so you have all the references. Tax-exempt unibond income is listed on Form 1040, line 8B, and it affects your modified adjusted gross income. Whereas distributions from a life insurance policy, it's non-reportable. It has no impact to your Medicare, no impact to your Social Security benefits. It does not affect your adjusted gross income, and it does not affect your deduction limitations by boosting your income levels. Muni bonds may be tax-free, but the income from muni bonds is calculated and impacts all of those benefits that may be impacted by your AGI. Non-modified endowment life insurance is completely asset protected in 37 states. It's protected against bankruptcy, liability, tort. In many states, the death benefit proceeds are even protected against the beneficiary's creditors. Whereas if you name your child beneficiary and your child's got some type of $100,000 collections issue going on and they inherit $1 million, in many states, they can't attach that $1 million death benefit that they've just received to pay off, their creditors can't attach it to pay off that debt. And it's a self-completing plan in the event of premature death. It's life insurance. So from day one, we have some death benefit that far exceeds what the contributions are going in. So let's say I'm a male age 40 and I'm putting $100,000 a year away into my life insurance policy. And even if I'm buying the least amount of insurance, I'm going to have some million, $2 million, $2.5 million of death benefit. If I were putting that $100,000 into a Roth 401k, which I can't do, but just theoretically, and the proverbial bus comes down the pike in year 5 and something should happen, my family's going to get the 100,000 a year for 5 years, plus or minus any type of market performance. If I'm funding an overfunded cash value life insurance policy and I'm putting in $100,000 a year for 5 years and something prematurely happens to me, my family's going to get a death benefit in the millions of dollars, income tax free. That's what I mean by self-fulfilling. Yes, we're putting money in, we're accumulating tax favored growth, tax deferred growth with tax free distributions on the back end for ourselves to supplement retirement income. But if I don't make it, my family is made whole as soon as the unforeseen event takes place. The proverbial bus comes down the pike and my days are over. My family's financial security will be secured because it's life insurance. I don't know of any other investment vehicle that you can put cents on the dollar away. And if something happens before I achieve my goals are self-fulfilled. So what's better than tax-free income? Again, non-reportable income. You don't have to disclose it to the IRS. There's no 1099 issued when you take money out of a life insurance policy if you're borrowing the money out via policy loans. And I'll give you a simple example. It's nothing special about life insurance. You go to the bank and you borrow $100,000 from the bank because you want to go out and buy an RV. Does the bank issue you a 1099 when they write you a check for a $100,000 loan? No. You borrow money from an insurance company, they're not issuing a 1099 when you borrow money from the insurance company from your policy. It's black and white tax law, right? It's center of the court. This is as plain Jane and vanilla planning as you can do from a tax code perspective. And it provides you flexibility in managing future tax burden, and it creates that might create additional that might impact your future tax benefits. It does not affect your AGI. And again, you go back and you listen as you go into retirement and you're going in to file for Social Security and you're going to sign up for Medicare and you're going to sign up for all these other benefits, and you could suppress your income, take all of your income that year, take it out of your policy, non-reportable income, go in, say, hey, here's my income level, and it helps you. Like, if you're making too much money and you go and apply for Medicare, you're going to pay a premium on your monthly Medicare premiums, right? Just ask anybody that's filed for Medicare recently. So it can reduce your taxation on Social Security. It can reduce your taxation on other taxable income. Why? Because this income isn't going to drive you into a higher income tax bracket because it's non-reportable. It can help you maintain or increase your deductions. Again, deductions get phased out as you make more money. Deductions are phased out. It can minimize your Medicare Part B premiums, and it can maximize your total after-tax dollars you have to spend. Whatever, and again, we're not saying people should put all their money in life. This should be one of the buckets, one of the sources of income that you're planning for going into retirement for supplemental retirement income. You got your 401k. You might be lucky and have a pension. You've got your non-qualified assets. You got some Roth assets, and over here you've got your life insurance, and and then some annuities as well. It's part of that spread, but the income out of this allows you to manage. What is your tax bracket? Where am I going to take income? What's the best place to do it? And it can also help you smooth out the bumps as other portfolios that you have are adjusting because of performance. So what are the more attractive features? Again, no 59 and a half early distributions, no age 72 going to 73, probably to 75 soon. You have flexibility of funding. We always, if we do illustrations, we'll show a 10-pay, $100,000 a year 10-pay going into a policy. But because we're overfunding it, which means we're putting in as much money as we can into the policy without losing its tax benefits. And the client says, in year 6, I had a bad year and my business cash flows off. Great. Your policy is well funded. You can skip that portion this year and you can make it up next year. Just because we show 10 years of 10 pay, because we're overfunding it from day one, it provides tremendous amount of flexibility as to the timing of the premiums. You can add disability income riders. You can add critical illness riders, chronic illness riders. You can add long-term care riders. There's a terminal illness rider that's built into almost all policies today, so that should you become terminal, and they define terminal as it's expected that your life expectancy is less than 12 months. You can actually accelerate the death benefit to help pay for some of those costs. And again, it's bankruptcy and asset protected in 37 states against liability, tort, and bankruptcy. It's one of those assets, that's not attachable. We had a case and it was a client that was in Texas and they were anticipating that they were going to get sued. They weren't getting sued, but they had substantial cash value in their life insurance policy. And they're like, am I protected? And it is protected. Whatever else is exposed, they can't get at that cash value. You have doctors and professionals out there that are in highly litigious professions. This aspect, the bankruptcy and asset protection alone, it's on par as if them putting money in pensions or qualified plans. It's a very powerful tool. And the long-term care riders, chronic critical illness, I put those all in the same type of class where, you got to go into a facility and you need cash flow, and you can get it income tax free off your life policy death benefits, acceleration of the death benefit, income tax free to help pay for those extended care costs. I don't know what other asset class, what other investment class has all of these features built into the product. So what's the structure? First and foremost, there has to be a need for life insurance. Now, people say to me, well, who needs life insurance? And my response is, well, it's actually easier to tell you who doesn't need life insurance. Somebody that doesn't have anyone else that they care about in their lives, who's no one else whose financial security that concerns them, right? That's really who doesn't need life insurance. It's of no value to you because there's no one else, you don't care about others and the outcomes that, once you're gone, you're like, hey, I'm dead, I don't care. Okay, you probably don't need life insurance. But anyone that's got a family, anybody that's got business partners, anybody that's got any type of liabilities has a need for life insurance. It is a great planning tool. The death benefit aspect of life insurance in and of itself is a fantastic planning tool. It provides liquidity at the worst possible time in someone or some family's life. It provides immediate liquidity, tax-free income. It provides all types of benefits for those that are left that you care about if something should happen to you. Now, the structure of it. I'd like to address a recent case. There's a case, Kyle Busch is suing Pac Life and some insurance agent because they sold him life insurance and they told him it was a retirement plan. And boy, did he get screwed. Hey. And it's because the guy that sold it to him designed the policy the exact opposite of everything I'm about to say. When we fund overfunded cash value life insurance, I'll take one more step back. If the IRS puts limitations on how much money you can put somewhere, is it because it's good for them or good for you? They limit the amount of money you can put into a 401k. Why? Because it's bad for the IRS, because you're saving on taxes, right? You're deferring taxes. How much money you can put in a Roth? It's because it's good for you and bad for the IRS, right? Long term. Well, the IRS puts limits. They put definitions as to how much money you can put into a life insurance policy for a given age and for a given face amount. They say you can only put this up to this amount into this policy and maintain these tax favored benefits on the cash value, the tax deferred growth, and the tax-free, tax favored distributions on the back end. So if the IRS is putting limits on it, it's a safe bet that it's probably a pretty good deal for you from a taxation perspective. So what do? We say, okay, Mr. Client, Mrs. Client, you want to start, you filled out all your pre-tax 415E pre-tax contributions to your profit sharing 401k, defined whatever, and you still have an income tax problem long term, and you want to mitigate and do some sound long-term income tax planning. Let's come up with a dollar amount that you think that you can sustainably fund over the next X number of years. We help the client determine what that budget is. What is it that I'm comfortable committing to? And I tell you, the great, you get a real estate agent that had a banner year, an attorney that just got a multi-million-dollar payout, and they want to shelter as much as possible in 1 year, and we're going to use that number to do structural life insurance. It's not going to work. That's not what we're talking about. It's a dollar amount that they feel comfortable that they can sustain long term. And again, it doesn't have to be year in and year out, but it's okay. Over the next X number of years, I'd like to put this much money away. So once we have that number, we go in and we buy the least amount of insurance that we can, and minimize the mortality and admin charges. Life insurance is full of charges and expenses, particularly in the first 10 policy years. I will guarantee you, it doesn't matter which insurance company it is, they're losing money. If that policy lapses in the first 2 to 3 years, they've lost money on the transaction. So they've got sales loads, they've got premium charges, they got all kinds, and every carrier has them. Some of them, there's all these knobs they can dial: mortality charges, admin charges, M&E charges. Again, all the carriers have them, and they just, whatever, they dial the numbers. Yeah, there's some differential between this carrier's got slightly lower surrender charges and this one, but generally speaking, in the first 10 years, the carriers have surrender penalties on these products. And we tell people, if your time horizon for this money isn't 10 years, don't put it in a life insurance. If your time horizon is 5 years and you want to start getting money out in the 6th year, don't put it in a life insurance policy. You're better off just putting it in a grinder and shredding it, because they are heavily loaded upfront products. And it's all disclosed on the illustrations. So we buy the least amount of insurance, minimize mortality, minimize expenses. We use an increasing face amount. Why? By using an increasing face amount, we can put the TAMRA premium in every year indefinitely, right? So the death benefit floats on top of the cash value. Then once the client has said, hey, I'm done funding this thing, you switch the death benefit from an increasing death benefit to a level death benefit, because that then caps out the amount of insurance that's being bought, and therefore the relationship between the death benefit and the cash value starts leveling out and can actually decrease over time. It's focused on cash accumulation, right? This is an income tax strategy. This is not an estate tax strategy. Oh, I've had attorneys trying to go, oh, this is going to make their estate tax problem worse. They shouldn't do this. And I'm like, well, it's like, oh, if I fund my 401k plan and build up $1 million, it's going to make my estate tax problem worse. I shouldn't fund my 401k. This is an income tax play. Estate strategies, that's a different presentation. We'll be doing that in the first quarter of next year. Ideally, we've got a 10-year plus funding time frame, and we're not looking to take distributions out 15 plus. That's not to say it can work and be effective with shorter durations. But again, you've got to get at least 5 years of max funding premiums into the thing, and you really want to the longer you let it defer, that the benefits, the tax deferral gets better and better every year. Right? The mortality and internal expenses get less and less in the policy because we're overfunding it, and all the sales loads start burning off. And then you get this compound tax-free compounding taking place in the policy. So that's kind of our ideal structure. Distributions, we typically will illustrate withdrawals up to basis. When you take your distributions out of your policy, because it's non-modifying endowment, it's first in, first out accounting. So again, what other asset class has FIFO accounting? So you get your cost basis out first, tax-free. It's a return of premium. Then you borrow the gains out of the policy from the insurance company. All distributions, whether they're withdrawals or loans, are going to reduce the net death benefit. And there has to be some net cash value left in that policy. Because let's say we put in $1 million of funding over 10 years. Our cash value is $2 million. And we take out $2 million in distribution, and that policy lapses before we die, I'm going to have $1 million taxable event. So we don't ever want the policy to lapse. And many of the contracts that we have something called an overloan provision rider on it that will prevent you from taking it out, where you could take it down to the last $10,000 of cash value, and then you just exercise the overloan rider, and it converts it to a paid up policy that can never lapse. Requires attention, requires planning, but that's the structure. We don't ever want them to lapse if you have substantial gains in a non-modified endowment life policy. And then how do the loans work? And people say, how does this work? All you're doing, technically what's happening is you have $1 million of cash value, and you say, I want $50,000 out of my policy. You go to the insurance company and say, I'd like to borrow $50,000. The insurance company doesn't actually take money out of your policy. They're writing you a loan out of their general fund, and they're loaning you $50,000. That loan sits on their book as an asset, just as loans sit on banks' books as an asset. That loan is a performing asset. They're going to then take and collateralize that loan with the cash value and the death benefit in your policy. So they're going to take and let's say it's a variable contract, which is my favorite. They're going to take $50,000 out of market risk, and they're going to put it into the loan reserve account within your policy. Why? Because they don't want to collateralize a loan with an asset that can go down in value. So they've taken $50,000, put it into a loan reserve account. Most policies have what's called wash loans, that after the 10th policy year, the crediting rate on the loan reserve account, let's call it 4%, equals the interest rate they're charging on the loan at 4%. So we call it a wash loan. And in most universal life policies, after say 10 years, have these favorable wash loans. And if you take loans out prior to the 10th year, there's some minimal spread where the loan reserve might only get 3 and they're charging you 4 on the loan. So you might have a 1% spread on that loan. So that's how it works. And again, it's no different borrowing money from the insurance company, borrowing it from a bank, borrowing it from a brokerage house. That's non-reportable income. Who? Anyone from age 0 to 60, high income, 250,000 plus, and they don't qualify for Roth. If you've got someone that's 35 years old, they're just starting out and they got $5, 6, $7,000 a year away to put away in savings, and they have a need for death benefit. We're going to go term insurance and have them fund a Roth IRA, right? I mean, that's the best bet for them, and we're going to encourage them to go have deferrals taken out of their 401k, get their employer matches, which are free money, and advise them. This is for people where they've they've taken care of all those pre-tax opportunities and they have excess income that they're trying to do long-term tax planning with. You need at least 10 years of deferral. As I said, don't if your client says, hey, I'm going to fund this for 5 years, in year 6, I want to start taking money out and doing this with it, let's not do overfunded cash value life insurance. It's not going to be the most efficient 6-year planning tool. Again, you're already maximizing qualified plans, taking advantage of your 415 pre-tax limits. You're still getting hammered by income taxes. You got to be healthy because these things are underwritten on an individual basis, or you got to have a spouse that's healthy. You have a need for asset protection. Business owners, with no qualified plan or one with limitations for owners and key executives. If you're a small business, you don't have a qualified plan, or you're the business owner, you have a qualified plan, but your ability to contribute to it's governed by the rank and file's participation in that plan, and you're being capped out at what you can put away. Again, this is a great alternative, and for all practical purposes for the business owner, it looks like a Roth 401k plan without funding limitations. Now, again, can't say that to the consumer, but that's what it looks like. And depending on who you're getting the policy from, it's possible that they could have the same company managing and providing their 401k solutions as is providing their overfunded life insurance, and the sub-accounts and investment options inside of the plans are identical. And the other thing I'll find is, most 401k plans, particularly in the small business space, have very limited options. They might have 10, 15, 20 options. And I'm not talking about all the 2050 retirement stuff. I'm talking about individual sub-account options. They're pretty limited. Most of the variable plans that we represent have in excess of 80 and 90 different sub-accounts that you can choose from to invest your funds. They're going to have passive options. They're going to have index/passive options. They're going to have actively managed options. They're going to have all kinds of options across the risk management spectrum, typically several multiples of what they might have in their 401k plan. So let's talk about the benefits of the life insurance. Tax-free income, non-reportable income, known tax rate. What's the known tax rate? 0. Creditor protection, no impact to AGI, Social Security, Medicare benefits, and a tax-free death benefit. Again, the death benefit, it's self-fulfilling. It provides immediate, from the day that policy goes in force and the client writes that check to the insurance company and they get issued a policy, that death benefit, that financial security for their families there day one. And I got to tell you, I'm talking about the tangible aspects. What about the peace of mind? I mean, I know I felt a lot more peace of mind about my daughter when I went out and got more life insurance and got my affairs in order and had significant death benefit. I own 3 different variable universal life policies. I feel good about that. That's, something happens to me, my daughter gets that death benefit income tax-free. Taxable investments, there's no tax-free income, there's reportable income. You have no idea what your tax rate is going to be between now and then 20 years from now or 25, 30 years from now. We just don't know. Most taxable investments don't share any creditor protection unless they're held in some type of an irrevocable trust. Again, different type of planning. They impact your Social Security. They're going to impact your AGI and any benefits that are linked to your AGI. And there's no self-fulfilling tax-free death benefit in a taxable account. Your heirs will get what you put in plus or minus performance. That's it. And it may come with some type of a, well, you get a step up in basis, so there's probably not a tax liability. So it's probably income tax free. So don't tell me, show me. So when we run this analysis on every case that we're showing an overfunded cash value life option for someone, you can't make a decision in a vacuum. Does it have value? Um, what I get a lot of, and you hear it with the talking heads, whether it's Ramsey or Susie Orman, and you should never do this. It's so expensive. And my retort is, it's expensive compared to what? Right? Expensive isn't an absolute term. It's relative to what? So, you know, Dave Ramsey, buy term, invest the difference. Okay. So if I sell a term insurance and sell a taxable mutual fund, there's that one side of the equation. And then if I sell a variable universal life policy, which is a life insurance policy with mutual funds built into them, called sub-accounts, then you run an analysis long term. Are the cumulative fees and expenses, and I agree, in the first 10 years, man, it's not pretty, right? Carriers they're not altruistic organizations. They're there to make a profit. Even if they're a mutual company, it's funny, the mutual companies' fees and expenses aren't very far off any of the stock companies I'm aware of, or the ones owned by private equity companies. Are the cumulative fees and expenses of that policy more or less than the cumulative taxation that you're going to face over here in that taxable account over the next 10, 15, 20, 25 years? I'm here to tell you, if you run the numbers using a fair analysis, the expenses of that policy cumulatively are going to be less than the cumulative taxation on that taxable account. So, we're going to optimize the policy design for a desired funding amount. We will run hypothetical taxable investment accounts, and we use real world fees and expenses. We use short-term, long-term capital gain ratio, 75 to 25, where 75% of the taxation is long-term capital gains, 25 short-term. If you look at the average turnover ratios in most actively managed portfolios, that's a generous assumption. Now, granted, you could go into index funds and your turnover ratio might be 10 to 12%. We'll run that too. We use capital gains taxation. We use turnover ratios, right? We use low turnover ratios, typically in the 25% range, 25% turnover ratio. So what does that do? It makes that taxable account tax efficient. If you have a high degree of long-term capital gains, you have a very low turnover ratio assumption in that analysis, it makes that taxable account tax efficient. And then we compare it and we'll run the numbers. Is the client better off? And in most instances, with the right time horizons, the client's going to be better off. We can't, and again, we can't mitigate market risk, but that risk is the same on both sides of the equation. There's no more inherent risk in a sub-account, the Growth Fund of America sub-account inside of a variable life policy, than the Growth Fund of America mutual fund account. So those two elements are the same on both sides of the equation. And again, let us show you. Come to us and ask us to take a look at an opportunity you may have to see, is this appropriate for your client? Again, we're talking, this is plain Jane black letter law, right down the middle of the court, right? I think it was Warren Buffett that said, listen, it's better to play in the middle of the court, not in the fringes, not trying to push the envelope. This is this vanilla planning that is super powerful. It's impactful and it's very effective long-term for your clients. So non-modified endowment life insurance, it's one of the greatest long-term financial planning strategies available to the affluent today. Non-modified endowment life insurance. I didn't talk about modified endowment life insurance. Again, that's not why we're here, but you have to understand it's its own. It has to be designed properly. We've got to adhere to the guidelines and the restrictions that the IRS and limitations that the IRS imposes on this type of a product. We're very good at it. We've been doing it for a long time. Our goal is to provide the best possible outcome that we can for your end user client. We're not beholden to any one company. We run every variable carrier we have on every case because it can vary. Carrier X, their sweet spot's 45-year-old preferred males, and then you got carrier Y whose sweet spot's 50-year-old smoking women. We don't know. Right? It's virtually impossible to keep track. So we run in our analysis every carrier we have access to, and we have access to all of the great carriers that go through independent distribution. So, and we'll provide that for you. Here's the analysis. Here's all the carriers we looked at, and based on the criteria we're trying to optimize for this case, this is the carrier that we're recommending, and it might not even be the one that's number one on top, right? But that's a conversation we have on a case-by-case basis with you. And again, we've got all kinds of e-platforms and electronic platforms to make doing business with us as easy as possible. Nothing I'm showing you here is unique to us, but we have, but conversely, there are no other insurance distributors like us that has anything more than we do either from an electronic or technological platform. We make it as easy as possible. We get you appointed using an electronic platform. We've got drop tickets, IGO, e-applications. Not that, when we get into really big cases, guys, when we're writing big premiums, we're going old school paper. Why? Because we want to manage that process and be in front of it. We don't want to leave anything to chance. And we manage the underwriting. We pre-underwrite the case. We make sure we've got our I's dotted and T's crossed before there's an app submitted to any carrier, and we know what's going on first. But we've got the jet issue. We've got electronic premium payment platforms, e-policy delivery, where you can send out DocuSign and PDFs of policies. We have everything from submission to commission. Most of it can be done without ink, but again, on bigger cases, we still like ink. And getting policies underwritten and issued is faster than it's ever been. So we recognize that in life insurance, it can be a challenge at times. It's not like dropping an annuity ticket or putting assets under management. And it's a little more challenging, but it's rewarding. Your clients need it. If you're not doing it for your clients, someone else is going to be talking to them about it. It's a way to strengthen and enhance your relationship with your clients by having the conversation. It's very tax efficient planning. It provides immediate financial security for your clients and their families. So again, I go back to my statement that it's one of the greatest long-term financial planning strategies available to the affluent today, bar none. Now, I've gotten in trouble saying that to people say, oh, that's, you're using too many superlatives there, Rob. It works. Give us a chance. If you found this a valuable presentation, reach out to your relationship managers, call our number, send us an email. We'd love to find out how we might help you with your clients in this solution. That's our presentation today. I have to say, it does say questions there. I have not figured out how to open this thing up to questions. Ryan, do you?
The chat is open, so anyone should be able to type a question if they have one.
Is there a way to unmute everybody? Well, we'll go to chat, see if we've got any questions in chat. Well, we don't have any questions coming in. I appreciate everybody joining us today. Thank you very much. We'll be sending out some notifications. We've got our first quarter series already in the can and ready to go. Have a very Merry Christmas. Have a Happy New Year. Happy Hanukkah. Enjoy the holidays, and we look forward to working with you in the new year. Thank you.
That's why I usually bring mine,
Thank you.
because if not.